PENTalk. I'm Beth Parker with Pentegra. So glad you're able to join us today. Before we begin, we have a lot of people signing on right at this moment. So let me just go over a few housekeeping items. First, if you'll find the control panel that's located on your screen, at the bottom is a question box. Here you can type in any questions during the presentation, and at the end, we'll get to as many as we can. We want to make sure we are respectful of your time, and end at 1:45. If we don't get to your question, we will definitely follow up with you afterwards. Tomorrow, you'll receive an email with a link to the replay and also a link to the slide deck. Let's get started. We're joined today by Rich Rouser, Senior Vice President, Client Services at Pentegra. Rich joined Pentegra in 1997 and has traveled the country visiting thousands of clients. One of his favorite things to do is to share his knowledge with others on the importance of retirement savings strategies. We're excited to have Rich walk us through the CARES Act legislation and what it means to you. Rich, thanks for presenting today. Let's get started.
Good afternoon, everyone. Thank you for joining the call today. That's one technical matter. Do we need to hit start broadcast or the not now that's on my screen?
It's broadcasting. We're good.
All right, very good. Thanks. So we're here today, I guess, unfortunately, to talk about the new legislation that was passed last Friday, the CARES Act. CARES Act stands for the Coronavirus Aid, Relief, and Economic Security Act. This is essentially the third round of government relief due to this pandemic that we're all experiencing. So we've got a couple of impacts, obviously, to individuals, businesses, and retirement plan sponsors and participants. So just to refresh everybody a little bit, in terms of the first couple of rounds of relief, round one was really pretty small bit of relief, about $8.3 billion. And that was earmarked towards health agencies for testing and some small business loan subsidies. Round two was about $100 billion, and that provided tax credits to employers for paid sick leave, and it increased some of the unemployment benefits as well as food assistance programs. And round three is definitely the biggest so far. Round three is a $2 trillion deal, again, providing checks to individuals and families. It's supporting airlines and cargo carriers with certain loans and grants, and definitely having some impact in terms of retirement plans and retirement plan participants. So we're going to talk about today the things that are impacting retirement plans in general, and more specifically, the impact on participants. So when I think about the couple of things done in the CARES Act, there are four impacts to defined contribution plans and or IRA accounts. And there's also a couple of provisions that positively impact or provide relief for defined benefit pension plans and certain money purchase plans. So in terms of the provisions, again, four for DC, three of them are optional, one is mandatory. So we're going to go through them one by one and take it in depth on each of these. So one of the first impacts on defined contribution plans is there is a new coronavirus-related distribution option available to DC plans, individual account plans, that have in-service distribution features to begin with. So, it's very possible there could be some plans out there that don't permit distributions prior to a certain age or prior to a normal retirement date or separation of service. But if you're like, most of the plans in this country do have some sort of an in-service distribution feature, and this really is just adding to the list of another type of distribution that's available under the terms of, or could be available under the terms of the plan. So essentially what this does is it permits impacted individuals to take up to $100,000 of distribution from a qualified plan and or an IRA type account And essentially it gets a free pass on the, I call it the excise tax or the 10% penalty tax that's normally applied to distributions that occur prior to age 59 and a half. Now, a couple of interesting things in terms of how this works. Number one, the distribution has to occur essentially between now and the end of the year, the end of 2020. That's requirement number one. Number two is from a participant standpoint, tax withholding, right? Normally on distributions that are rollable to another qualified plan or an IRA account, normally there's a 20% mandatory withholding tax, federal withholding tax. That actually is exempted here, and it goes to the standard withholding, which is 10% at a federal level. Now, of course, the individual participant can choose to waive that or increase it or make it a higher or lower amount. There's some flexibility there. So let's talk next about taxability of benefits. The benefits, there is definitely a tax break here for participants. The benefit is, or the distribution amount would be taxable over a 3-year period of time. So the way it says it in the law, it's taxable ratably over 3 years, beginning with the year of the distribution. So the first year of the distribution obviously is 2020 if it occurs, and then 2021 and 2022. So essentially you're taking a third of it each year and adding it to gross income for the period. There is kind of a relief valve at the participant level. Participant could choose to pay all the taxes in year one or year two for that matter. So I can kind of envision a scenario where maybe somebody is out of work, for this year and wants to make sure the balance of the benefit is taxable next year. Maybe their income is going to be very, very low next year, and maybe they'll be back to work the year after. So, there are some definite tax planning strategies at the participant level. The other thing that's interesting with this distribution is it can be repaid to the plan. And actually it could be repaid to any plan that, quote unquote, that the participant is a beneficiary of. So in theory, I could repay this back to the same qualified plan that I took the distribution from, or I could potentially roll it to an IRA account or something like that. So when it goes back into either an IRA or a qualified plan, of course, it's not going to impact what we call the annual addition limitations of the year. It's essentially treated as a rollover, so to speak. Now, one of the complexities with that is, what if I choose to repay this over, as late as 3 years from the date, or the day, basically 3 years from the day after I take the distribution is the repayment period. I would have paid, certainly maybe either 1 or 2 years of federal and or state income tax on that money. And now I'm repaying it to the plan. So it's possible or almost certain you'd be able to do an amended tax filing to recover taxes that might have been paid on that money, in the early years of the distribution. So, again, it's not technically called a hardship distribution. It is technically called a coronavirus-related distribution, right? So there is, qualification rules that folks are going to have to meet, which I'll get to. I'll definitely get to in a couple of minutes here. So that's one impact on qualified plans. Now, one thing I didn't say yet is the voluntary changes that have been made by the CARES Act are optional. Plan sponsors do not have to adopt them. So the first three things that I talk about today are definitely going to be optional features. If you choose to allow participants to take advantage of these features, you can run them basically on what we call operational compliance. Basically say, look, I'm going to allow, for example, this corona-related distribution up to 100K and allow participants to do that. And I just have to make sure that the plan is amended to reflect that feature by the end of the 2022 plan year. And by the way, I don't know if any of you might have been on some of the webcasts I did for the Secure Act. That's a similar amendment deadline for any of the provisions under the Secure Act that we talked about last month. Initially, I saw some of the legislation on this one going towards an amendment due by the end of this year. I'm glad in the final versions of what was signed into law, it's been made consistent with some of the actions you might have to take for Secure Act amendments. So that's where we are on that one. Now, the other voluntary option that plan sponsors can permit is an increase in loan limitations for corona impacted individuals. And we'll get into what it means to be an impacted individual in a moment. But essentially, if you think of the normal qualified plan loan limitations, it's typically the lesser of $50,000 or no more than 50% of the participant's vested account balance. So essentially, those loan limitations are doubled for somebody who's impacted by coronavirus. So 100,000 is the max loan limit, and it's now increased to 100% of the participant's vested account balance. Actually, just simply double what it once was. Couple of other things here, though. Typical to loan limitations, it's going to be offset by the highest outstanding balance within the preceding 12 months. So all the other normal loan rules would apply. One question we got on this already is, if my plan doesn't currently have a loan feature, does this automatically put that in the plan and make it available for me under this operational compliance that I talked about a minute ago? And the answer is no. In other words, if your plan does not permit loans currently, the fact that the CARES Act put this option out there, it doesn't supersede what your plan document says. Now, so what's the recourse? The recourse would be to say, hey, whoever is, if we're your service provider, ask us to do an amendment to the plan to allow loans, and then on an optional basis, you can adopt this additional flexibility. Similar thing goes with early distributions that I mentioned just a couple of minutes ago, right? So very similar rules. You got to have a basic feature in the plan. These optional features do not override whatever your plan document currently says, but it potentially expands the ability of participants to utilize some additional flexibility. So a couple of other things on the loans. Essentially, this loan, a coronavirus-related loan, would have to be taken during the 180-day period, roughly a 6-month period of time, beginning on the enactment of the law, which was Friday, and that would take us about somewhere through about the third week in September. It's either September 22nd or 23rd. So anybody who potentially takes a loan between now and then could apply for a coronavirus-related loan. So it's a 180-day period that this is available. Now, couple of words of caution on the two things I've talked about so far. In terms of service providers and record keepers, we, at PENTagra are working hard to get everything we need in place to make these things happen. We're updating everything from some of the web software to the distribution forms and elections, so on and so forth, that individuals have to make. There's additional communication we need to get to plan sponsors to enable them to affect these things. So I'm going to get to how we're going to do that in just a moment. Let me get on with yet another provision, which is, again, another optional provision under the CARES Act. And this is the ability to extend loan repayments for up to 1 year. And this would apply to both new and existing loans. So if I'm an impacted individual, and if I already have a loan outstanding, I could actually delay my future loan repayments, essentially the ones that are due for the balance of this year. I could defer each of those for up to an additional year. So if somebody is impacted, you need to let us or your service provider know, and we need to work with you to kind of stop, future loan deductions if you're doing it via payroll deduction. And then we need to work with you to do a reamortization of the loan because essentially it gets reamortized sometime beginning in 2021. Important to know that any interest that otherwise would have been due on that loan between the day it's suspended, right, the day loan repayments and year end, essentially, or actually I should say through whenever that payment is due, right, all of the interest that accrues during the period still has to be paid. So you don't, the participant doesn't get a free ride on the interest payment. That accumulates and gets re-amortized into the loan when it's redone for 2021. So it's going to be a little bit, I say, tricky, right, in terms of again, if you're doing this via payroll deduction, number one, is the employee on your payroll, or are they on a temporary leave or furlough or something else? Number two, to remember to restart those loan withholdings sometime in 2021. So again, we're working on the ability to help our clients do that, to monitor it. We definitely have to modify some of the internal automated features that we have in terms of those touch points that we go out to clients in terms of when those loan repayments are due. So again, just something to keep in mind. It'll be a little bit of an impact for all of us in terms of managing this. So again, so far I've mentioned three things. The three things are all optional at the plan sponsor level. One is the corona-related virus distributions up to 100K. The second is the fact that you can take a loan, and essentially a coronavirus-related loan up to 100K, so an extended amount of money can come out. And number three is extension of new or existing loans that otherwise would be due. Those are all optional features. Now, in terms of our thinking on that at the client level, right, we're thinking through how to implement this most effectively. And our current thinking is to provide plan sponsors with, an alert, client alert, saying one of two things. And I think we're going to lean towards assuming that most plan sponsors would like to offer these features to their participants. So we're going to attempt to put this together as what I call a negative election, saying, look, we're going to assume you're going to adopt all three of these optional features. We'll proceed on that basis, and we'll make notes in your records and files here that ultimately we would need to do an amendment for the plan to account for that. On that notification, we intend to put check boxes or whatever to opt out. Like if you really didn't want to offer any of these features, or maybe your plan doesn't even have a loan feature or an in-service hardship, whatever. So if for any reason you don't want to go ahead with it, you would just let us know. Please don't proceed. Because again, with the clients we've spoken with so far, I don't think I have not run into anybody who said, no, I would not like to offer these to my participants if they need them. So we're going to do it that way, I think is where we'll end up. So let's talk about participants who qualify. What are the qualification rules to take advantage of these optional features? So number one, it's got to be an individual, a spouse or a dependent who's been diagnosed with coronavirus, COVID-19, or who has SARS, this version of SARS. So, it's interesting when we look into it. By the way, it's a shame we have to look into this stuff, but COVID-19 is actually the disease, whereas SARS is actually the virus. So the bottom line is you're going to be diagnosed with one or the other. That's one way of qualifying. The diagnosis has to be by a test approved by the Center for Disease Control and Prevention, right? And I truthfully don't know exactly what that means either. So again, let me go back a second. So the qualification is you, your spouse, or one of your dependents is diagnosed, and it's verified on an approved test, or you experience adverse financial consequences, related to coronavirus. And there's a laundry list of things they put in the law to very, very specifically speak to what qualifies. So, for example, if you're under quarantine, if you're on furlough, that could be deemed to be an adverse financial consequence. If you've been laid off, if your work hours have been reduced, if you're unable to work due to the lack of childcare, and this is a big one that I've heard of quite a bit, even though those folks who are able to or permitted by their employers to work, let's say remote, lack of childcare is a problem, certainly for folks with very, very young children, right? So that can prevent you from working and create a hardship. And there's another one in there for essentially for business owners, right? If you're reducing or closing your business, and again, in our immediate area, there's just so many businesses closed between, whether it's a restaurant or the dry cleaner or everything other than a grocery store or a gas station. And quite frankly, I don't think anybody's buying gas because nobody's driving anywhere in our area. So again, if you're an impacted business or business owner, you can definitely qualify. So the next step in this is if I say that I'm qualified, I can actually, under this law, self-certify, right? I could go to my employer and say, look, I believe I'm an impacted employee or a participant in the plan, and I want to take the higher loan amount, or I want to take the coronavirus distribution, or I want to extend my loan repayments, whatever it may be. The law says I'm permitted to self-certify. Now, that decision is ultimately up to the ERISA named plan administrator, right? Because normally it's that fiduciary, so to speak, who approves, distributions or loans or anything else that's available under the plan. So the law very clearly says if you're the fiduciary or if we're the fiduciary, we can actually rely on an employee's certification to that fact. Now, we're not. Our position currently is we're not going to require evidence of a CDC test or any of that. That's at least where our current thinking right now. We can rely on the employee certification. Now, what we're doing in terms of the updated distribution request or loan forms, we're putting a series of check boxes for the participant to look at, right? So they can make a claim that they're an impacted individual, and they can check one of, I think we've got 3 or 4 boxes there, that either they or their spouse or dependent's been diagnosed, and they have a certified test, right? And or there's a financial hardship, and we'll probably list out the financial hardships, and they can check the boxes as to which ones actually apply. So we feel, more than comfortable with that, because that's essentially what this law says. They're trying to make it easy for participants who need the money, to actually get their hands on the money. So again, the one thing I caution everybody is, look, we all want to do what we can do for people who are negatively impacted here. It will take some time for service providers to, modify systems, come up with new, think about, the loans. Essentially, some of these loans can now go out up to 6 years rather than 5 years, right? Amortization schedules, all that documentation that normally has to get processed and completed, those aren't normal situations that are set up. So we're working hard to get that stuff done. We're working every day to get client communications out on this, and to work through processing any of these distributions that are going to be required. All right, so I'm going to talk. Let me talk about the plan amendment again. I think I mentioned this earlier. Codifying any of the optional features that you've adopted has to be done by the end of 2022. Governmentals always get another couple of years. They get until 2024 to do the optional amendments. And as I mentioned, if you need a real amendment, meaning I have to add a loan feature because I never had one, that we believe you have to do more currently. Now, again, there are some of the groups that, trade groups that we're involved with lobbying to get us some relief on that also, and maybe get us some operational compliance on that type of element of the plan. But I can't guarantee any of that's going to happen at this point. So it is what it is. We'll work with the rules as we know them. The fourth provision I'm talking about today is this, by the way, is mandatory. It's a temporary waiver of the required minimum distribution rules. And essentially, they're saying that, and we actually put a stop to this on Friday when this was signed into law. We stopped processing RMDs for 2020. And, the way our participants are set up, we have literally every month of the year, somebody, sometimes people like to get their distribution in April or May or June or whatever it may be. So we've actually stopped processing. Now, we did process RMDs prior to Friday, and obviously in earlier portions of the year. So let's talk this through a couple of different ways. Number one, effective immediately, there is no such thing as an RMD for 2020. There was nothing that, now, if you already took it, well, let me go back. I took my RMD last year. Well, last year was last year. This doesn't provide any relief at all for last year. If somebody came to us today and said, well, I still want you to pay me my RMD. Well, we can't pay an RMD going forward, right? Because the law basically says this doesn't exist for this year. We could, however, process what I call a voluntary distribution, a voluntary election to take money out of the plan. So assuming the plan allows that individual to take that money out of the plan on a voluntary basis, we can process a distribution on that basis. There is a change in tax withholding, right? The way RMDs work, and I realize I'm getting into the weeds, but I think you want to hear some of this stuff, right? An RMD is not normally rollable. You can't roll it to an IRA or any other qualified plan. So the law on tax withholding basically said, it's a 10% Fed tax withholding rate, and the participant could either increase or decrease that amount. Now, if a participant comes and takes a voluntary distribution, the mandatory federal income tax withholding is at the 20% rate. As far as I know, there's no wiggle room on that. So it's a difference in how taxes are collected for sure. Now, there is a possibility, and we'll maybe get to this in a later discussion on this. If I already got an RMD processed earlier this year, is it possible for me to roll it over? Right now, our thinking is yes, you can do that, but I want to give it a little bit more thought. We wanted to get this critical information out to you right now today. So what are we doing as a service provider? I've seen what I hope is a final draft of the communication going out that's going to be directed to the participants that we know we're supposed to get RMDs for this year. We're trying to get that out this week for sure to let them know what's going on and to let them know that potentially they can take voluntary distributions from the plan. So, this is not, this is a mandatory feature, so that, we don't really have any wiggle room on this, other than what I told you earlier. If somebody wants a voluntary distribution, we can definitely process it. So that's that feature. So I want to talk next, because we've been getting this question a lot. Now, suspension of safe harbor contributions was not part of the CARES Act, but it is something that has been out there for a while. And, we've been hearing from plan sponsors who are under pressure financially that, gosh, you know what? I mean, things were great before this thing, but now that, they're effectively shut down, they really can't afford to do any contributions to plan, let alone safe harbor contributions. So there's a communication I believe we sent to clients last week, but I'll reiterate some of the details here. You can potentially suspend safe harbor contributions, and you can do it as long as your safe harbor, the original notice that you gave to participants, contain language that you have the right to reduce or suspend it. So number one is, if we prepared the notice for you, that language is already in there. So, but if it was some other service provider, you need to check what your notice actually said. So if that's there, and if you want to suspend, you would just need to let us know. There's a 30-day advance written notice that you need to give to plan participants. And as a service provider, we always need a little bit of time to kind of put, number one, review the provisions of the plan. Number two, make sure everything is in good order. Number three, get that out to you. And number four, there's mailing delay or transmission delay to get this notice out to your participants. So it could take actually up to 45 days is kind of what I'm thinking. But to the extent that we can expedite it, we would attempt to do that. So you can suspend if need be. That can reduce some of the burden at the plan sponsor level. To the extent that I think most of our clients are actually making safe harbor contributions payroll by payroll. However, there are a handful of plans that actually don't make them until the end of the year. So if you suspend, you actually have to kind of go back to the beginning of the year, look at the salary for the eligible people who would have been getting this contribution, and look at the date of suspension and essentially be committed to making the safe harbor contribution for that period of time. So again, our folks at our relationship managers would be able to walk you through this if you need assistance with it. But just keep in mind it's not an immediate action. It's going to take a little bit of time, number one, to draft the paperwork, number two, to get the notice and sit through the 30-day waiting period. A couple of other things come to mind in terms of contributions, and that is, I may have required contributions to a different type of a plan. If it's a DC, I don't think a lot of people have money purchase type plans anymore, but if they do, and if there's an end of year condition, potentially you could amend the plan to avoid that year-end contribution. But there are some other things to think about in other defined contribution plans where you may have a relatively hard-coded contribution into the plan provisions. So you should talk to your relationship manager about what do we need to do if you need to slow down or suspend or stop those types of contributions. So we can help with that is my point. I want to talk next about funding relief for defined benefit plans. There's only a couple of provisions that impact defined benefit plans. Number one is kind of I don't want to say a funding holiday, that's not the right word. There's a deferral of required contributions that occur between now and the end of 2020, right? So essentially any minimum required contribution or quarterly contribution that was otherwise due can be deferred until January 1, 2021. So if you defer payment until that point in time, you'd have to make it up with interest, but at least the immediate cash call would not be there and would not be required until that point in time. So that's one aspect of defined benefit relief. There's actually two more. I'm only really going to talk about one more, which is the benefit restriction status relief. So, due to a confluence of events, right? Number one, the market declines. Number two, the fact that some of the interest rate structure has gone down. Lower interest rates by and large increases pension plan liabilities, obviously low market values, reduce the asset base, and therefore the funded ratio of the plan, that's a metric that we use for a couple of different reasons, can be severely decreased. So, and one of the things that happens, if that funded ratio goes too low, if it gets below 80%, there are benefit restrictions that kick in for participants, right? There are limitations on lump sums, and if the funded ratio gets even worse than that, there could be a complete restriction of lump sum benefit payments. So what this law does is it basically, and I'm going to make it simple, it basically says, look, take the funded ratio from a year ago, basically from the 2019 period, and use that for this year. So essentially, if you were already okay, above 80%, you got kind of get to preserve that status for this year is the point. So there's no negative impact on somebody who is just about to retire and maybe take a lump sum or a partial lump sum from the plan. So again, these features are available to defined benefit plan sponsors, single employer plan sponsors, as well as those in our multiple employer defined benefit plan. There's another DB feature. I'll mention it. If you want more info, please call me after. It impacts certain cooperatives and certain charities that sponsor small DB plans. So I'm not really going to speak about that today because I don't think that's a big representation in the group. There was on Saturday, believe it or not, an extension of the deadline to submit plan documents for restatements. So anybody who might have been, number one, furiously working on those, they would have been due today, as a matter of fact. That's been extended for a couple of months. Probably not a big relief for anybody except maybe for some other firms who might not have been able to get the work done due to who knows what, coronavirus, economy and impact, so on and so forth. So I'm sure it'll provide relief for some plan sponsors, but I think most of our clients were well covered here, but I wanted to point it out anyway. There is in the law the ability for the DOL to postpone certain deadlines under ERISA. So to date, they have not yet extended any of the due dates, at least if they did, I didn't see it published yet. Pretty much we anticipate that that's going to happen. we're also looking at a couple of other things, right? In terms of other relief for plan sponsors, potentially, relief from certain 401k tests. There's a dramatic impact on people actually collecting a paycheck these days, and that's a big, big problem for the economy. It's going to be a big problem, I think, for qualified plans in general. By and large, a lot of the people not collecting paychecks are non-highly compensated employees. And even if they do come back to full employment, even in a short while, they're going to be negatively impacted, and we might see them cutting back their salary savings rates. So there is talk of trying to get some additional relief. By the way, midweek last week, there was a version of this bill. It was the House version of the bill that had additional defined benefit relief provisions in it. Things like getting rid of a 7-year amortization, resetting all the unfunded amort basis to zero, then re-amortizing over 15 years. That never made it into the final version that was signed Friday night. So anyway, my long story short is there is undoubtedly additional relief coming down the road. I'm going to get to questions in a moment. So with that said, I want to just cover one or two more things. We said there's 3 rounds of government relief here, right? And this is the 3rd round. This was a $2 trillion package. We definitely think there's going to be more relief coming down the road. I've heard that Congress is already talking about taking up stimulus bill number 4 sometime in April. And I think a big part of how much additional relief we get is how long this whole pandemic is actually going to continue. The word we got the other day was, prepare to be locked down essentially through the end of April. So we'll see. We'll see where that is, and we'll see how much additional relief is going to be needed to help folks in this country. So that's all we have for right now. Again, I'm saying there's going to be a fair amount of communication we're going to continue to provide to folks. Beth, I don't know if we got any questions that maybe we can try to answer before we conclude today.
Absolutely, Rich. We have a ton of questions, so we'll see how many we can get through. I just want to say before we get into the questions that just to remind everybody, you're going to get an email tomorrow with the replay and the slide deck. We've had several questions about that, so I just want to let everybody know that will be coming tomorrow. All right, let's jump into the questions. Does the plan have to be amended before offering the new distribution or loan feature?
So two ways to think about that. If my plan already has a loan feature in it, I don't need to amend the plan today. I have to amend it by the end of 2022 to allow the new optional feature provided under the CARES Act, right? I can operate under what I call operational compliance. So I can simply adopt it and worry about doing the amendment at a later date. Again, if my plan doesn't have a loan feature at all, yeah, you have to take action to put a loan feature in the plan, a regular old amendment, and then you can optionally adopt the CARES Act loan feature or the hardship, or I shouldn't say hard, or the CARES Act distribution feature. Good question. Thank you.
All right. And that was, just to verify, there was another question on when must it be amended by? Was that 2022?
So, yeah, 2022 for most plans. The end of the plan year beginning in 2022. I recognize we have some off-calendar year plans, so to speak. Or by the end of 2024 if you're a governmental plan.
Okay. Is a loan required before a distribution can be taken?
No, I think that question is probably in line with some of the way hardships used to be, right? So this is not technically a hardship distribution, although when you read the letter of the law, it kind of is, right? They keep calling it a coronavirus-related distribution. But as we said before, I've got to be an impacted individual. I either have to have the virus, which to me is a hardship, right, or have a financial hardship. So most people who have the virus or the family has it, there's definitely a hardship. May not always be a financial hardship. So maybe that's why it's not called a hardship per se. It does simply add to, for the technicians in the room, right, Section 72T, which is where they talk about the additional 10% penalty tax on early distribution. So they basically just added another section there and said, hey, if you're taking it for this reason, that extra tax does not apply. So to answer the question, no, you don't have to loan out before you do this.
Okay. If your spouse is quarantined, furloughed, laid off, etc., would you qualify for the distribution?
Yes. Yes.
Yes. Okay.
Yes. In other words, for me to qualify, it's either going to impact me directly, or my spouse, or one or more of my dependents. So any of those criteria qualify.
All right. One person wants to know: do we know if they've already taken an RMD, can they put the RMD back?
I think the answer to that is going to be yes. Can I roll it over? I believe the answer to that is yes. I said what we'll do is in the follow-up we'll answer that question precisely. Again, we didn't spend a lot of time focusing on that yet, but again, I think I said earlier our view is I think that's going to be possible to do, but we'll confirm that one.
Okay. Does the waiver of RMD only apply to those affected with the COVID virus, or is it to everyone in RMD status?
Yeah. Just to be crystal clear, right? The RMD waiver is across the board. It's you know what? It may be worth a quick explanation as to why they did that, right? Quick explanation. Let's say I had $100,000 in my account as of December 31. Due to the market declines, my account is now only worth $70,000. And let's say, I don't know, I was 75 years old and I was supposed to take 5%. I'm rounding off the RMD factor. 5% of my $100,000 would have been a $5,000 distribution that I would have to take. Well, my account already went down to 70 due to market conditions. Now I got to take another $5,000. Now I'm down to 65,000. So I've lost a tremendous amount of value in my account, including, quote unquote, an overinflated RMD for this year, right? Because it was calculated based upon an account balance I no longer have. So, the idea of Congress was, look, let's give people some relief. Let's not decimate their accounts even further. Let's just call off and by the way, they did this back in, I think it was 2008 during the financial crisis. They kind of put a temporary moratorium on RMDs at that time also. So again, it's just a way to relieve a little bit more stress, if you would. Now, again, as I mentioned earlier, some people may still want the RMD. You got to look into a voluntary distribution from your plan if that's the case. But that's a good question. Thanks.
All right. Next question. If my plan offers a 2-loan maximum, is there flexibility to extend to 3?
Oh, you know what? That's a real that I can see that being an issue. I can definitely see it being an issue. So again, our view is, if my plan only allows up to 2 loans for a participant, and if I come to the plan and say, oh, I'd like one of the coronavirus loans, right? Can I do it? Our view, we're going to take a conservative approach because, as I said before, the provisions have to be in your plan document to begin with. I can't, the new law doesn't mandate that you provide the loan feature. Again, the view is the new law doesn't mandate that you say, oh, well, in certain cases you can have 3 loans, per person. So I think in that case, that very specifically, you would have to amend the plan to allow up to 3 or take the cap on the number of loans out. Yeah, we actually got that question ahead of the call. I'm glad you brought that one up, or somebody asked it, because I can definitely see that potentially being an issue with some of some of the plans that we have.
All right, next question. Back on the RMDs, since they're being waived this year, next year, will they be automatically reinstated, or will new paperwork be needed?
Now, yeah, next year RMDs will continue kind of business as usual. No need to really do anything. We would be looking at the account values here. We look at the ages of participants, and we would just kind of resume RMDs kind of business as usual. Now, the question is, will we maybe put some additional paperwork out to remind people? I'm sure we probably will do that probably more towards year end. I think we also ask questions like, what do you want to do with tax withholding, things of that nature. So there'll probably be an addition. I got to be honest with you, it's too far. We're trying to get through where we are today. But yeah, basically from our end, we're going to resume as usual. We're going to assume they're going to continue unless for some reason the government extends that kind of relief into next year.
All right, Rich, we're at our ending time mark now. I want to thank everyone for all the questions, and if we did not get to your question, we will follow up with you after the call today.
Thank you very much, everyone.
Have a great day. Bye, everyone.